Welcome to The Deep Dive. We're here to cut through the noise and give you the real story behind the markets.
That's right.
Today, we're jumping into the MI Homes second quarter earnings call. It's quite a look at how a big home builder is navigating, well, what everyone's calling a pretty tough economic scene.
Yeah, challenging macroeconomic backdrop, I think was the phrase. But what's really striking is MI Homes isn't just, getting by. Management described the market as maybe a C to C plus.
Right, not exactly booming.
Not at all. But they posted what they called an extraordinary 14% pre-tax income. I mean, that's something. They seem genuinely optimistic, and it seems grounded in a pretty solid strategy.
Okay, so let's unpack that. How did they manage it? Maybe start with the headline numbers for Q2 2025.
Sure. So top line, they hit record second quarter revenue. $1.2 billion, that's up 5% from last year.
Wow, okay. Record revenue in this market.
And deliveries.
Also a record for Q2. 2,348 homes delivered. That's up 6% year over year. So operationally, things are moving. Pretty impressive, yeah, considering all the chatter about housing slowing down. What about profitability? Margins, returns?
Still strong despite the pressures. Gross margins were around 25%, return on equity at 17%. Now, pre-tax income, that did dip 18% compared to last year, landing at $160.1 million.
Okay. An 18% drop sounds significant.
It is, but you have to put it in context. That $160 million still represents a 14% pre-tax income return. Honestly, a lot of builders would kill for that kind of return, even in a great market.
Good point. So still very profitable. And earnings per share?
Diluted EPS was down 14%, came in at $4.42 per share. Sort of follows that pre-tax income trend.
Got it. Now, what about new demand? Sales pace, new contracts?
Okay, so new contracts for the whole quarter were actually down 8% compared to last year. But they still maintained a sales pace of about 3 homes per community per month.
3 a month? How does that compare?
It's decent in this environment. But the really interesting part was the trend within the quarter. Management pointed out that April and May were slower contracts, down 12% each month. But then June actually saw a 1% increase year over year.
Oh, interesting. So like a rebound towards the end.
Exactly. Could be a sign of stabilization, maybe buyers adjusting, or maybe their incentives started kicking in more effectively. We'll see. And cancellations stayed pretty manageable at 13% for the quarter.
Okay, 13%. So buyers who sign are mostly sticking with it.
Yeah.
And pricing, did they have to slash prices to get those sales?
Not really slashing, no. The average closing price was $479,000.
Yeah.
That's down just 1% from $482,000 last year. So slight dip, probably reflecting some targeted incentives, but not, deep cuts across the board.
Okay, that makes sense. So that's the snapshot. Pretty solid results, all things considered. Now let's dig a bit deeper. You mentioned margins earlier. They came down 320 basis points year over year to 24.7%. Management said they're starting to level off. What does that really mean for the outlook?
Yeah, that was the key message. They were pretty clear they don't expect another massive drop like that. They could see margins might drift a little bit lower, maybe down towards 24%, perhaps even 23%. But the feeling was, the big hit might be done. They don't see another 100 to 300 basis point decline coming. It suggests they feel they have a handle on costs and incentives now. It points to maybe more stability ahead for profitability.
That's definitely something investors would want to hear. Okay, what about the other side of the coin expenses? Selling, general, admin, the SG&A line. That ticked up, right?
It did. Rose to 11.3% of revenue.
Yeah.
That's up from 11% last year. So about a 7% increase in the actual dollar amount.
What's driving that increase?
Mostly growth. They pointed to the higher community count. They opened 50 new communities, or stores as they call them, just in the first half of this year. And naturally, that means more headcount, more operational costs.
So investment in growth, essentially.
Exactly. They expect it to continue as they keep expanding their footprint. It's the cost of growing the business. The bet is that revenue growth will eventually outpace it.
Right. Now, something that really jumped out from the call was their balance sheet. Management called it the strongest in company history. That sounds like more than just talk.
Oh, absolutely. The numbers are, frankly, staggering for a home builder. They ended Q2 with a record $3.1 billion in equity. That translates to a book value per share of 117%, up 17% year over year.
Okay, strong equity base. But the cash and debt situation?
Get this, $800 million in cash on hand and literally zero borrowings on their $650 million credit line.
Wow. Zero debt on the revolver and $800 million cash.
Yep. Their overall debt to capital ratio is just 18%. And if you factor in the cash, Their net debt to capital is negative 3%. They basically have more cash than debt.
That's incredible financial flexibility. What does that let them do?
Anything they want, almost. They can weather downturns easily, invest countercyclically in land if they see opportunities, buy back stock aggressively. They aren't beholden to capital markets or banks. It's a massive, massive advantage right now.
And it sounds like they are using that flexibility for buybacks.
Definitely. They spent $50 million buying back shares just in Q2. They still have $150 million left on their current authorization. And since the start of 2022, they've bought back 14% of their outstanding shares.
14%. That's a serious return of capital.
It signals huge confidence from management in their own stock's value. They think it's a better use of cash than chasing deals or just sitting on it.
Okay, let's switch gears slightly. A big tool for builders right now is mortgage rate buydowns. How is MI Homes using those?
They described it as strategic and effective. They're using buy-downs to, well, buy down the interest rate for buyers, making payments more affordable. This drives traffic and helps close sales, especially in this higher rate environment.
But it costs them, right? Hits the margins we talked about.
It does, absolutely. They acknowledged it impacts profitability, but they find it's most effective for homes that can close quickly, say, within 60 days.
Ah, so that ties into inventory strategy.
Exactly. It means they need a good supply of spec homes, homes already under construction, or finished, ready for quick move-in. This is something existing home sellers just can't compete with. It's a huge lever for new home builders.
Makes sense. And speaking of inventory in communities, they're growing there too.
Yep. Back at 234 communities, up from 211 a year ago. That reflects those 50 new openings in the first half. They also have slightly more homes in the field, 5,100 versus 5,000 last year. And significantly, 36% of their Q2 deliveries were actually inventory homes sold and delivered within the quarter.
So that spec strategy is clearly working, driving a big chunk of their business.
It seems to be key right now.
What about their land pipeline to support future growth? That's always crucial for a builder.
They have a lot of land. Management sounded very confident here. They own about 24,500 lots outright. They figure that's less than a 3-year supply based on current pace.
Okay.
But they also control another 26,000 lots through option contracts. So total owned and controlled is around 50,500 lots. That's roughly a 5 to 6 year supply overall.
5 to 6 years. That's substantial. Any geographic concentration?
Yeah, a big chunk, 69%, is in their southern region. Management feels it's an excellent land position and push back on any idea they were reaching into, tertiary or lower quality locations. It seems very strategic.
Okay, massive land bank, strong balance sheet. Let's zoom out again to the bigger picture. Macro conditions, market fundamentals. They acknowledge things are challenging and choppy because of rates. So how do they square that with their overall optimism?
They keep coming back to the long-term view. They firmly believe the long-term fundamentals of our industry are sound. They talked about the chronic undersupply of housing overall, plus demographics like household formation, creating underlying demand.
So the idea is that buyers are out there just waiting.
Pretty much. They said many potential buyers are sitting on the sidelines waiting for a better rate environment. So it's seen as pent-up demand, not destroyed demand. The underlying need for housing hasn't gone away.
Interesting perspective. Did they talk about differences across their markets? You mentioned the southern focus for land, but how's performance varying region by region?
Yeah, quite a bit of variation. The Midwest markets, places like Columbus, Indy, Chicago, Minneapolis, Detroit, Cincinnati, they describe those as actually outperforming, doing pretty good. They're investing heavily there.
Huh. Why the Midwest?
Often more stable economies, maybe, and critically more affordable price points generally. That relative affordability provides a buffer against rising rates compared to, say, hotter coastal markets.
Makes sense. What about other areas? Carolinas.
Charlotte and Raleigh still quite good, was the description. Holding up well.
And Florida, always a big market.
Florida they called a mixed bag. Orlando seems to be doing better than Tampa and Sarasota on the West Coast, although they did say Tampa saw some improvement in Q2. There's been a bit of a reset on that West Coast, maybe dealing with insurance costs and price adjustments.
But still bullish long-term on Florida.
Very much so. They believe the long-term migration trends and demand drivers are still intact, even if there's some short-term digestion happening. Their presence across different Florida markets probably helps them navigate that mix.
Okay. And Texas, another huge state for builders?
Also varied. Dallas and Houston, while maybe softer than their peak boom times, are still considered excellent housing markets. I mean, together they account for something like 15% of all new home sales in the U.S. So still fundamentally strong.
But not uniformly strong across Texas.
Right. Austin, which has a huge run-up, is apparently crawling its way back. It sounds like a slower recovery there. And San Antonio is described as very sensitive to interest rates.
So even within one state, you see really different dynamics based on local factors and rate sensitivity.
Absolutely. It really highlights how much housing is a local game.
One last cost point, any worries about tariffs, specifically Canadian lumber?
They address that. About 20-30% of their lumber comes from Canada. But management said, essentially, we haven't seen anything yet that makes them expect a big cost increase. They mentioned they can substitute supply if needed, and overall construction costs have actually been pretty flat recently. So they seem prepared to manage it.
Okay. And wrapping up their strategy, it sounds like it's not about growth at all costs.
No, definitely not. The theme was profitable growth, controlled expansion within the 17 markets they're already in, leveraging their strong local teams, that huge land bank, and their product expertise. It really does sound like they're focused on the long game, not just chasing quarterly volume numbers.
Which, that fortress balance sheet allows them to do.
Precisely. They aren't forced into making bad deals or sacrificing margins just to keep the machine running. Discipline seems key.
So if we tied this all together for you, the listener, what we're seeing with MI Homes is pretty remarkable resilience. They're navigating this tricky market, maintaining solid profits, and sitting on this incredibly strong balance sheet.
Yeah, and things like the strategic rate buy downs and that carefully managed land pipeline, those give them a real competitive edge, particularly against folks trying to sell existing homes right now.
And it all feeds into that confident long-term view management keeps expressing. They see the demographic tailwinds, the housing shortage, and they've positioned themselves with that land bank to really capitalize when conditions eventually improve.
What really stands out, I think, is the financial discipline. The low debt, the cash pile.
Wow.
It just gives them so much flexibility. They can ride out volatility, invest smartly, keep buying back shares. It's a position of strength.
All right, now for our regular segment. This is not financial advice. Let's be absolutely clear. This is purely for informational and entertainment purposes. Please do your own research before making any investment decisions.
Definitely. Okay, disclaimer delivered. So, considering everything we talked about, MI Homes' amazing balance sheet, the cash, that huge 5 to 6 year land supply, and management's conviction about rates eventually easing and housing fundamentals winning out. Here's an outrageous but plausible trade idea.
Lay it on us.
We're calling it the land bank leveraged long. The core idea is to get long-term, capital-efficient exposure to MI Homes' potential upside.
Okay, how? Not just buying stock.
Well, you could, but for leverage. Think about buying long-dated, deep-in-the-money call options, maybe looking out to January 2027 or even 2028 expirations.
So options contracts giving you the right to buy shares at a lower price in the future.
Exactly. It lets you control exposure to the stock's potential rise, leveraging that intrinsic value from the land bank as rates maybe fall and demand kicks back in over the next few years, but without tying up as much capital as buying the shares outright today.
Interesting. A leveraged bet on their long-term strategy playing out. Anything to refine that, make it more asymmetric?
Potentially. You could consider pairing it. So while you're long MI Homes via those options, you could simultaneously take a targeted short position in another home builder.
Shorting another builder? Which kind?
Maybe one that seems more highly leveraged, maybe less diversified geographically, perhaps a builder you perceive as chasing short-term volume with maybe less sustainable incentives, not just rate buy downs.
So you're betting on MI Homes' disciplined strategy and assets winning out over a weaker player.
Kind of. It creates this asymmetric bet. You profit if MI Homes executes well long-term, leveraging their strengths. And the short position potentially hedges against broader sector downturns or provides extra profit if the weaker player struggles. It's basically a bet on quality and patience winning the long game.
Fascinating thought experiment. Again, not advice, just exploring possibility.
Just brainstorming.
Yeah.
So to recap the call itself, MI Homes delivered a really solid Q2. They're navigating a tough market using smart operations, strategic incentives, and crucially, that fortress balance sheet.
Yeah. So as you think about the housing sector moving forward, maybe consider this. How will that growing gap in balance sheet strength and land strategy between builders really shake out? Who are the likely long-term winners in this cycle?
And what's the ultimate impact if these higher rates stick around longer than expected? How does that change buyer behavior? And can builders keep bridging the gap with incentives without eventually crushing their own future profitability? Lots to think about.
Definitely. Well, that's our deep dive for today. Thanks for tuning in.
Yeah. Thanks for listening. We encourage you to keep exploring these market dynamics on your own.